All right, let's dive into CarParts.com's wild second quarter. It was quite a ride. Started with some really tough news, but ended with a huge strategic shift that might just change everything for them. So let's break it all down.
So this is the number that really tells the story. 16.3%. That's how much the stock dropped the day after their earnings call. Ouch. You see a number like that, and you've got to ask, what on earth happened? What did investors hate so much? Well, the answer is a bit more complicated than you might think. And here's where it gets interesting. The headlines, they screamed EPS miss, which was true. They did miss on their earnings per share. But, and this is a big but, they actually beat on revenue. So what gives? Why did Wall Street completely ignore the good news on sales and just hammer the stock over the earnings? That's the puzzle we're going to solve today. Okay, so here's our game plan. We'll start with a look at that tough quarter. Then we'll peel back the layers and see what was really going on behind the scenes. We'll get into the massive strategic change they just announced, talk about what to watch for next, and wrap it all up with our official rating and thesis.
All right, first up, let's get into the Q2 scorecard. These are the numbers that really spooked the market. So here it is, a real tale of two numbers. On the revenue side, a beat, $151.9 million. That's up over 5% year over year. You'd think that's a reason to celebrate, right? Well, not so fast, because that was totally wiped out by the earnings miss, a loss of 23 cents a share when the street was looking for a loss of only 16 cents. That conflict right there, that's what sent the stock into a nosedive.
And if you dig a little deeper, the picture gets even murkier. Gross margin got squeezed down to 32.8%. Things like import tariffs and selling lower margin stuff really started to bite. Then you've got adjusted EBITDA, negative $3.1 million. And maybe most worrying, their cash pile dwindled to under $20 million. When your cash gets that low, it really ties your hands. It's tough to invest, tough to grow. You're just trying to stay afloat.
So what was really driving all this? You can think of it like a massive tug of war. On one side, you had the company pulling as hard as it could with its own initiatives. And on the other, you had these powerful market headwinds pulling right back.
And you can see that battle right here. In their corner, they were actually doing some good things. Their app, over 1 million downloads. Their CarParts Plus membership, gaining traction with over 7,000 members. E-commerce revenue even hit a record. But they were fighting an uphill battle against some serious stuff. Tariffs were a huge drag, margins were getting squeezed, and sales on places like Amazon and eBay were just soft. It's tough to win when the whole market is pushing against you.
So what do? Well, management had to make some tough calls. They shut down a distribution center in Virginia and trimmed their corporate staff. The result? They're on track to save about $10 million a year. It's not fun, but they were basically right-sizing the business for the new reality they were facing.
Okay, so all of that, the bad earnings, the cost-cutting, it was really just the setup. The real story, the main event, dropped right after the quarter ended. The company finished its big strategic review and made an announcement that, honestly, changes the entire game.
Let's just look at how this played out. Back in March, they say, hey, we're looking at all our options. Then in August, on the Q2 call, they're like, yep, still looking. So for months, there's this cloud of uncertainty. But then, bam, September hits, and they announce a massive $35.7 million strategic investment. A month later, the board starts to change. This is a company going from we're not sure to we have a plan in a real hurry.
And this deal, it's like they made a checklist of their biggest problems and just started ticking them off. 1, that weak balance sheet we talked about, this cash infusion immediately strengthens it. 2, need more products to sell? This partnership with A Premium brings in over 150,000 new items. Just wow. And 3, shipping costs are too high? Well, their new partner Zong10 has this huge logistics network they can tap into. This isn't just a small tweak, it's a total strategic reset.
So, because of this pivot, the whole story has changed. When we look ahead to their next earnings call, we're not asking the same old questions anymore. The focus has completely shifted.
Yeah, with new money in the bank and powerful new partners, the question is no longer about survival. It is all about execution. Can they actually make this new plan work?
So going forward, the market is going to be in show-me mode. Here's what I'll be watching for. 1, can they actually get those 150,000 new products integrated and selling? 2, are we going to see real tangible cost savings from this new logistics deal? 3, how fast can they get back to a positive adjusted EBITDA? And a really big one for me,
Are they confident enough to bring back their full-year financial guidance? That would be a huge signal. These are the proof points we need to see.
Okay, so let's put it all together. After looking at the rough quarter and this potentially game-changing new strategy, here's where we land with our final rating and thesis.
Our rating is market perform. Now, what does that mean? It's not a screaming buy, but it's not a sell either. It basically means we see the huge potential here, but we also see the huge execution risk. They have to prove they can pull this off. It is the definition of a show-me story right now.
So to sum up our thesis, CarParts.com is no longer just a standalone company fighting against the tide. They've transformed into a partnered platform. And that new model could unlock serious scale and finally better profits. But, and you've heard me say this a few times, it all comes down to execution. Everything depends on making these new partnerships work. And that really is the million-dollar question, isn't it? They've got the cash, they've got the partners, they seem to have everything they've been missing for years. So, is this the moment? Is this the combination that finally unlocks the real profit potential of this company? I guess we're all about to find out over the next few quarters.
And just as a final reminder, this is not financial advice.